Welcome to IAS Project. We are continuing with Indian economy lectures for UPSC Civil Services exam. In our previous videos, we have talked about national income. We have seen that there are mainly three methods to measure national income. That is, production method, income method, and expenditure method. Expenditure method is also called as consumption method. We have already seen what GDP is and what NDP is. Also, within the income method, we have talked about GNI and NNI, that is, gross national income and net national income. In this lecture, we will be talking about GNDI, that is, gross national disposable income. So, we have seen that GDP is a territorial concept, meaning whatever occurs within the economic territory of a country, that economic activity will be counted towards GDP. We have also talked about GNP. We have seen that in GNP, we have net factor income from abroad concept, meaning whatever is the factor income that is coming from abroad and whatever is the factor income that is going to abroad, you will be factoring that for calculation of GNP. We have also talked about GNI, where we have seen a concept of primary balances from the world. Here we have seen that we have accounted for primary balances which are coming from the rest of the world and the primary balances which are going towards the rest of the world. We have accounted these net primary balances with GDP and then we have calculated GNI. Similarly, in GNDI, that is gross national disposable income, we have a concept called net current transfers. So this is also net primary balance. So in GNDI, we have a concept called net current transfers. For this, we need to understand current transfers. Current transfers are mainly of three types. We will discuss current transfers in this video and in the next video. Before going into what GNDI is or what gross national disposable income is, let's try to understand income. For example, you are an individual who works for a company and for that you will be getting an income. So from this income, you will be mainly paying taxes to the government, which are the direct taxes on your income, and some income you will be using for spending and the remaining income you will be using for saving. So in this manner, income can be divided into three verticals, that is taxes, spending and saving. Let me try to rearrange this equation. I can also write this equation as income minus taxes. When I write here taxes, I mean direct taxes, that is income tax or wealth tax and those kinds of taxes. I can write this equation as income minus taxes equal to spending plus saving. Now, whatever are these two components, that is income minus taxes or spending plus saving, is simply called as disposable income of that individual. So, from this equation, I can make a definition for disposable income. Let's see the first definition. Disposable income is the income available which can be spent or saved. Spending in economics is simply called as consumption. So the formula can be written like this. Disposable income is income available for consumption plus income available for saving. So disposable income mainly goes into two parts, that is for consumption and saving. Now let's imagine a case. For example, the employee is very poor. Will he be able to save anything? Almost no. Let's assume that his income available for saving is zero. Then what happens? Disposable income for that person is nothing but income available for consumption. So we can write a new definition for disposable income like this. Disposable income is the maximum available income for consumption. Similarly, if there is a very rich person and he is not consuming much, in that case, this will be zero. Disposable income in that case is nothing but the maximum income that is available for saving. However, these two are imaginary cases because any person will be having some amount of saving and he will be having some amount of consumption. Therefore, it is best to describe disposable income in terms of addition of consumption and saving. Now, for making this definition of disposable income, we have defined it as spending plus saving. Now, let's use this term for defining disposable income, which is given in the second definition. Disposable income is arrived at after deducting the direct tax payments, example income tax, from the income. If the case is of a disposable income of a person, we will call the direct taxes as income tax. If it is a company, we call it as a corporate tax. Also remember that direct taxes can be wealth tax also. What is the difference between wealth and income? Difference between wealth and income is nothing but when income accumulates, it becomes wealth. Or when income exceeds a certain level, then it becomes wealth. So using the second definition, I can write a formula for disposable income like this. Disposable income is nothing but total income minus direct tax. That is this part. So I hope you have understood what disposable income is. With this knowledge, let's move forward. Let's talk about indirect tax first. Indirect tax is such kind of tax where tax burden and tax incidence are on different entities. Let's try to understand what tax burden is and tax incidence is. Tax burden is nothing but the burden of tax. That is, whoever is the final entity that is actually bearing the tax. Tax incidence is nothing but the entity who is paying the tax. Let's understand tax burden and tax incidence using the example of GST, that is goods and services tax. Let's say you are a customer and you went to a restaurant to have a dinner. After having dinner, the restaurant has given you a bill. Let's say you have consumed items worth 1000 rupees. Now, the restaurant is also going to add GST to this. So it will add 5% GST. So the final bill will be 1000 plus 5% GST at 1000, that is nothing but 50. So 1050 rupees. So this will be the bill that has to be paid by you. So the customer will give 1050 to the restaurant. Now the restaurant will take 1000 rupees for itself as income, and it will also pay 50 rupees to government as GST. So in this case, who is actually paying the government? That is, the restaurant is paying the government. But does this money belong to the restaurant? No, it is actually being given by you to the restaurant, which is then simply forwarding that GST to government. So from this concept, we can understand that tax incidence is on restaurant because restaurant is paying the tax to the government. However, the money actually belongs to you. So 50 rupees is your money which you are giving to restaurant, and then restaurant is giving to government as GST. So tax burden is on you. I hope this explains tax burden and tax incidence concept. Tax incidence is on that person or entity who is paying the tax to the government. However, tax burden is that person or entity who actually is ultimately paying the tax. So in this case, the 50 rupees is ultimately coming from your pocket. So the tax burden is on you, that is the customer. Now, let's talk about direct tax. Direct tax is such tax where tax burden as well as tax incidence is on the same entity. For example, direct taxes are income tax, corporate tax, wealth tax. For example, again you are an employee. If you are earning some income, then income tax will be cut from your account or your salary, and it will be credited to the government. At the end of the year, if you want, you can claim income tax returns by filing an ITR also. So if you file that ITR and if you're going to get some kind of return, it will also come back into your account only. So in this case, tax incidence is on you as well as tax burden is also on you. So income tax is basically a direct tax. Other examples of direct tax are corporate tax, which is actually income tax on the profits of corporates and companies. Wealth tax, when income accumulates beyond certain value, it becomes wealth. Examples of indirect taxes are GST is the most famous example. Sales tax and service tax are also examples of indirect tax. Let's talk about gross domestic savings. We know that within the disposable income, we have two components, that is for consumption as well as savings. So domestic savings, we know that are nothing but savings of the country. Gross domestic savings, we have already discussed what gross is. Gross simply means total. Gross domestic savings is basically the savings of all households, that is individuals and their families, and private sector as well as public sector put together. So all these three entities contribute towards gross domestic savings. There is a formula or expression called as rate of saving, which simply means gross domestic savings divided by GDP into 100. If we look at gross domestic savings of India, we can make certain kind of observations. We know from our world history that after Second World War, many countries in Asia have gained independence. For example, in East Asia, we have countries like South Korea, Taiwan, China, And also in Southeast Asia, we have countries like ASEAN countries, which gained independence mainly after Second World War. So if we compare India's savings rate with the savings rates of these countries, India's savings rate have been very low until very recent past. India's savings rate have been relatively low. There are certain reasons for the low savings rates in India. Let's look at those reasons. One is lower level of per capita income. India's per capita income is very low compared to these two countries. We know what per capita income is. Per capita income simply means net national product divided by entire population. So per capita income basically measures the income a single individual on an average is earning for an entire year. So that is called as per capita income. In India, the per capita incomes are low. As we have seen, when per capita incomes are low, disposable incomes will be less. What does that mean? Income is low, so disposable income is low. When disposable income is low, as we know, disposable income can be used for consumption or saving. When income is very low, there will not be much amount that can be saved. So most of the amount is used on consumption, that is spending. So saving will be less. So lower level of per capita income means ultimately lower savings. Also poor banking habits. How does banking work? Banking works mainly like this. For example, this is a bank. Let's say there is a person 1. This person has more money than that is needed for his consumption. It means that surplus income for this person. What he will do? He will go to a bank and he will deposit it in the bank, for which he may earn interest. Now, there is a second person who actually does not have income, but he has ideas to have a business. What he will do? He will approach a bank and the bank will give him some money. So because of this money, now this person can go and invest in business and he can get profits. So what we can understand from this is, when income is actually invested in a formal manner in banks and NBFCs and stocks and other options, what happens is that will be utilized to grow the economy. That is, banks will lend to other people and other people can get returns. And he will give certain profits to banks and banks will ultimately give certain interest to you. So this is how savings, if used properly, can work. However, let's say our banking habits are bad. That means that whatever is the surplus income, you're not investing in stocks or market or depositing in banks, but you're putting them, let's say, in your pocket or in your home. What happens? That money will not be useful for any other person. It may be useful for you in case of emergencies. So because of poor banking habits also, savings rates in India have been low. Also, there is an increase in unproductive expenditure recently. For example, a concept of conspicuous consumption. What does conspicuous consumption mean? Conspicuous consumption simply means that purchasing such kind of items, although you don't need them, but to increase your prestige and in a kind of, let's say, a show-off manner. For example, you don't need to purchase iPhone every year. If you, let's say, buy iPhone 12 or iPhone 13 this year, it will be working fine for, let's say, next 3 or 4 years or even more if you use it carefully. However, what you want is, you come into societal pressure and you think, my friend has iPhone 14, now also I have to buy iPhone 14. Or let's say someone has a bigger car, now you also want to have a bigger car. But you do not need a bigger car. Whatever car you have, it may be used as fine. Whatever phone you may have, it may be used fine. However, you want better car, better phone and all better aspects of life. This is called as conspicuous consumption. When you go beyond your needs, so much beyond your needs, that whatever the item is there, it will not have any marginal increase in its value or effect for you, then purchasing such kind of items is simply called as conspicuous consumption. The fourth point is low private corporate sector savings. If we look at developed countries, most of their gross domestic savings, that is almost greater than 75% of their gross domestic savings, they come mainly from corporate sector. That means that companies are saving more money while households are actually not saving more money. However, the case is reverse in India. It is actually households that are saving more money. So this is also one of the reasons for low savings rate in entire Indian economy. The fifth point is low public sector savings, mainly because of poor performance of PSUs. We know that PSUs have very less efficiency compared to private enterprises. That is why government is very much interested in disinvestments, which means privatization. We will talk about disinvestments in a separate video because this is a very important topic. We have many kinds of disinvestments actually. We can have strategic disinvestment, we can have non-strategic disinvestment, we can have outright sale also. Let's talk about this fifth point more. Low public sector savings were mainly because of poor performance of PSUs. PSUs traditionally had lower efficiencies compared to the private sector. One of the reasons for this is also government policy, because government actually installed PSUs mainly because it wanted to generate jobs, especially in areas or regions where there was not much economic development. So immediately after independence, when government formulated policies for establishing PSUs, its main reason was not profit. Its main reason was also not efficiency. Its main reasons were social considerations like generating jobs in areas where there are no jobs, as well as making India self-sufficient. So traditionally, public sector savings in India have been very low. These are all the reasons why low savings rates were seen in India compared to economies like South Korea, Taiwan and ASEAN countries, although all these countries got independence from their colonial rulers around the same time. Let's follow up in the next video. Please like and share this video. Also subscribe to IAS Project. Thank you.